think the dramatic increases we've seen in terms of precious metals, steel and other commodities, I don't see that coming through to customers in huge measure later this year.
We want to strongly recommend that people wear masks in indoor settings, even if you're vaccinated.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust.
This is Bloomberg Surveillance, Early Edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Not playing games, Tencent slips the most in a decade after Chinese state media decries video gaming as spiritual opium. Bringing back the buybacks, Standard Chartered announced it will repurchase $250 million of shares and pay out a dividend as profit jumps. Our exclusive interview with the CEO coming up. And big oil's big beat. BP joins its peers in increasing buybacks and dividends as higher crude prices boost the bottom line. We'll hear from Bernard Looney. But it's not necessarily animal spirits dominating this market, more so spiritual opium, or the phrase the Chinese media used to describe what's happening with video games. So a nervous market as we got a handoff from Asia that was concerned about more regulation. Still, we're looking at a Euro Stoxx 600 up 0.3%. Similar story when it comes to U.S. futures after falling yesterday. So perhaps some of the stronger earnings pictures carrying us through. Yes, we're about a basis point higher on your nominal 10-year yield, but that doesn't tell the story of yesterday of this huge flight into the bond market. Everybody using every opportunity they can to send yields lower. So right now hovering around a February low. Let's go ahead and get straight into earnings, though. Standard Chartered continuing the strong earnings season for Europe's banks. It's buying back $250 million of shares and planning a small dividend. That's after reducing credit losses, and those helped the Asia-focused lender beat on profit in the second quarter. Its CEO, Bill Winters, spoke to Bloomberg's Rashad Salamat.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust. So we don't see a big fall off. There's always an element of seasonality, and we know that the August in particular tends to be a slow month. We'll see if that comes through this year. But generally, I think that the business momentum feels very good.
How does the Delta variant play into this and your fears therein?
You know, we live in fear of what comes next. We have a big operational hub in India. Our Indian business was hit very, very hard. But in the first half of the year, our Indian results are extremely strong. So good income growth, good cost
percentages.
20% increases in the key business lines in India. And that's been very encouraging. So the Indian market has demonstrated a tremendous resilience through some very difficult times. But it's not over. And we're obviously going through tough times in Indonesia right now, Malaysia, some of our African markets. And while so far relatively little of this has translated into actual loan losses, it's still possible that could manifest itself. And at some point, governments will also find it a little bit harder to respond to all this and to keep things on the right track. But I'll say so far, so good.
How would the bond repurchase program in the U.S. being reduced, tapered, etc., affect your business in particular as we move towards maybe a higher interest rate, a normal environment?
I mean, we're all focused on where interest rates are going. We're most sensitive to the short-term interest rates, but it's also easier for us to make money if we have a steep yield curve. And relative to what the market was expecting when we last spoke, or when we spoke in a detailed way in February, the yield curve is quite a bit steeper, despite the fact that obviously longer-term rates have come back down. If the Fed begins to taper and we get an easing back up of 10-year rates or longer-term rates, which there's no sign of right now, I will say, right?
I mean, 1.17% for a 10-year yield is incredible.
There's no sign. But I think that also reflects a fundamental concern about the economic malaise, that maybe the very, very, very good times are petering out a little bit, which may be true. But like we've seen it in China. China boomed in the early post-pandemic recovery days, and now it's normalizing. Well, that's normal, right? And that's fine. Normal is fine by us. I think it will help to avoid some of the bubbles that could come across anyway. And hopefully we'll get back to a little bit more normal yield curve over the next few years.
But taxpayers got to pay this bill back, haven't they? Ultimately, they've got to foot the bill as to what's happened fiscally speaking. So That, of course, dovetails into the IMF also talking about and downgrading growth forecasts in this part of the world. How do you make provisions for that, and how are you seeing it?
Yeah, governments do have to pay back the money that's been borrowed, but the cost of carrying that debt is very low, right? Because most of that was borrowed at close to zero interest rates, or at zero interest rate, or if you're in Europe, it's borrowed at negative interest rates. So the rush to pay that back is not too pressing. But we would expect to see a normalization of economic activity. So we've had a rolling boom on the back of stimulus and COVID recovery, and that's going to ease. The U.S. stimulus is going to ease up. The Chinese stimulus is already easing up, and that will normalize global growth.
Standard Chartered CEO Bill Winters there, speaking exclusively to Bloomberg's Rashad Salmat, to just point out his mask. Because he was exempt from quarantine in Hong Kong, the rules dictated that he have to keep a mask on during the interview. Very interesting and kind of surreal to see. But later on, we'll get more into banking earnings. We're going to be speaking to Bloomberg Intelligence senior bank analyst Jonathan Tice about this morning's bank earnings. Of course, Standard Chartered there among one of them. Now on to China, where Chinese tech once again is in focus, this time with social media giant Tencent at the center. The stock cratering today, recovering a little bit, but after an offshoot of China's official news agency criticized video games, calling them spiritual opium. Joining us for more is Peter Elstrom, our executive editor for Asia Technology. Peter, I mean, pretty remarkable moves to see in Tencent after the Chinese big tech has already been under a lot of pressure. What exactly was it that the state media said that caused Tencent to just absolutely nosedive?
Yeah, it has been a tumultuous day here in Asia. As you pointed out, the state media publication came out and criticized gaming. It gave some anecdotes about kids who had been online playing games for hours at a time, 8 hours at a time, and it talked about the dangers of this spiritual opium, which certainly caught attention. So you saw Tencent shares fall very, very sharply at the open. Shortly thereafter, an interesting thing happened, though, and the website removed the link to this story that was criticizing gaming so forcefully. So Tencent shares bounced back up after that, and people thought, oh, there's this sigh of relief that maybe it's not going to be so bad afterwards. And then Tencent, on its official social media account, posted some steps that it may take in order to limit the amount of time that people actually play on games, taking these suggestions from the government about cutting back on gaming for kids very, very seriously. So there are a few things that they called out, including limits on how much kids can play games on weekends, on vacation times, particularly if the kids are under 12 years of age. So people are on edge because you've seen these rolling crackdowns come out of Beijing against financial technology, against education companies, and a bunch of others. So they're worried that gaming is going to be next.
Do we have an idea if there will actually be some regulation put on the industry? I mean, that kind of fold in the saga of removing the link for the story, does that indicate a sort of what direction that Chinese authorities might be leaning towards when it comes to this?
Well, it's a good question, and I think at this point, really, people do not know where this is going to end up. Gaming has come under criticism for years in China. It was about 4 years ago when state media called games poison, and there was a concern at that point that Tencent was going to get hit, along with some of the other gaming companies. One thing that Tencent appears to be doing here is signaling that they may take some proactive steps to be able to limit the amount of time that kids spend on gaming in particular. They're talking about requiring people to have their real names on accounts so you can keep track of these people, figure out what their ages are, and then perhaps impose some sort of limits. But regulators have not spoken about what they're planning on doing at this point, so the company may have some different ideas about where this is going.
Peter, you'll have to stay on top of that for us, where exactly those changes from Tencent come. That's our Peter Elstrom, our executive editor for Asia Technology. Thanks so much. Now, coming up, September taper. Federal Reserve Governor Christopher Waller weighs in on the debate. That's ahead of Friday's job report. We'll discuss it up next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hey, Danny. The U.S. has reached President Biden's goal of 70% of adults being at least partially vaccinated against the coronavirus, about a month later than planned. Meanwhile, San Francisco and surrounding counties are reinstating mask requirements in indoor public spaces, regardless of your vaccination status. New York City has strongly recommended masks indoors, but without mandating it. Now, Germany is to widen COVID-19 vaccinations to include all 12 to 17-year-olds in an effort to reinvigorate the nation's flagging inoculation drive. The move goes beyond advice published by the government's independent vaccine commission, which recommends jabs for youngsters with pre-existing medical conditions. And New Zealand's central bank is further restricting access to mortgages as it attempts to cool a red-hot housing market. From October, the RBNZ is reducing the proportion of low deposit loans that banks can make. New Zealand has one of the world's hottest property markets, with prices surging 30% in the year till June. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Now on to the Fed, where another Fed official has weighed in on the taper debate. Governor Christopher Waller says he could back an announcement by September on scaling back the central bank's bond purchases. That's if the next two monthly U.S. employment reports continue to show gains. Now, his comments also come ahead of Friday's non-farm data. Joining us now is Victor Yort, BNP Paribas Global Head of Credit Strategy and Desk Analyst. Peter, thanks so much for joining us this morning. Victor, rather, apologies. Thanks so much for joining us this morning. It's pretty remarkable to see that everything that happens, everybody seems to want to send yields lower here. 10-year nominal yields reaching their lowest point since February earlier yesterday. Does it make sense to you that this is the direction that we travel? Do we continue just to see those lower yields?
Well, I think it's an awkward situation for the Fed, given that they are just ahead of announcing a QE taper, and the way that whole yield move lower has played out, I think, is not at all what they would have expected. So at one level, inflation expectations are sticky, well above 2%, so they're sort of credible there. But the whole move lower in yields is driven by lower expectations of real yields, and that would be consistent with the market saying either you're facing stagflation ahead or that the Fed isn't going to tighten policy at all. So I think it is a awkward situation for the Fed. Can it continue? I think when this move started, back in April, the consensus expectations of where rates were going was decidedly bearish. That seems to be shifting, but shifting fairly slowly, and will increasingly, I think, put a headwind towards how low we can go.
Right. And of course, this creates some oddities in other markets. The real yield adjusting for inflation on BBB corporate debt now moving negative. I mean, what do you do with that area of the market? Is that something you want to own right now?
So with respect to corporate debt, I think we're actually supposed to be a bit cautious here. The underlying credit trends are fine. And the most important thing that's coming out of the earnings season at the moment is that corporates are still extremely risk-averse, holding close to record amounts of cash liquidity. And that means two things. One, it means obviously fundamental credit risks are extremely low. Corporates essentially default remote. And secondly, it also means that they really don't need to issue a lot of bonds, because they have the funding internally. So corporate bonds become sort of scarce. But what I think has changed since the early part of the summer is that the market is now positioning much longer than it was. So you're now in a much more crowded marketplace. That's true for both banks and asset managers, and introduces some vulnerability that really wasn't there before.
Interesting. So a crowded marketplace, does that mean that you want to kind of get out of the proverbial door, as it were, now for concern that we might see a stampede at some point?
Yes, avoid the crowds this summer. But seriously, it is one of these situations where when you have crowded positions, the frequency and the depth of corrections start to pick up, and that clearly allows investors to add, hopefully at better levels.
Yeah, avoid the crowds. Victor, solid advice both for maintaining healthy, avoiding COVID, and avoiding any damage in your credit holdings. Victor, thanks so much for joining us this morning. That was BNP Paribas Global Head of Credit Strategy and Desk Strategy, Victor Yort. Now, on to the banks. We're going to discuss Standard Chartered plans to pay a dividend as its profit jumps. SocGen says it will proceed with its buybacks, subject, of course, to what the ECB decides. Up next, we'll analyze the latest banking earnings with Jonathan Tice from Bloomberg Intelligence. This is Bloomberg.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust.
That was Bill Winters, Standard Chartered CEO, speaking exclusively to Bloomberg this morning. Let's get more into the morning's bank earnings. We're joined now by Jonathan Tice, Senior Banks Analyst for Bloomberg Intelligence. Jonathan, first off, thanks so much for joining us. So we had Standard Chartered this morning. You had a masked Bill Winters there talking to our Rashad Salamat, announcing a buyback. When you looked through their earnings, what are some of the key takeaways for you?
I think that the issue we've got with Standard Chartered, and we've actually got a focused idea on it, is once again, we're being asked to wait until 2022 for growth. So there's no revenue growth this year. And they're still not doing enough on costs because every bank is now writing back provisions taken last year. A lot of banks have buybacks, a lot of them more meaningful than for Standard Chartered. And yet here they are again, currency's going against them, asking us to look through that and also saying, well, we may miss our target this year if we need to accrue for more variable comp. So I think had the stock not underperformed so heavily this year, it would actually be down today. So pretty disappointing results, really.
Jonathan, you're definitely striking a different tone than certainly Bill Winters, and even the market, those shares up 1%. Of course, another bank that reported this morning and was also pretty optimistic was SocGen. And earlier this morning, I did speak to its CFO, and he said this about its buyback program. Take a listen.
We have announced a share buyback in the second half of the year. So we will complete the share buyback. That's obviously pending a necessary administrative authorization by the ECB for an amount of 470 million euros.
So, Jonathan, in that conversation, William, the CFO, also told me that it was the bank's best quarter ever. Considering you struck a little bit of a different tone with that of Standard Chartered, do you think that that's an accurate description when it comes to SocGen, at least?
Well, it wouldn't have been the best quarter ever, but certainly for equities trading and for certain parts of the business it was. French retail's improved very nicely, but again, I point to the share price. I mean, SocGen is up nearly 60% this year. Standard Chartered's down 5%, and yet SocGen's up another 5% today. So they continue to deliver, and they're over-delivering on capital, whereas, as I say, for Standard Chartered, I think had it not underperformed so heavily year to date, it would be down today because they're just not doing enough on costs. Whereas if you look at SocGen, this quarter, their revenue grew 17% more than their cost base, which is a very, very good number. Look at Standard Chartered, that number was negative.
So, Jonathan, if I could get you to widen out a bit, we have a lot of European bank earnings under our belt now. When you look across the space, do we need to approach European banking any different than we did before the earnings? Have we learned anything material about where the banks currently stand?
Well, I think that there are some banks that have managed to deliver pretty good revenue this quarter. If I look at BNP, for example, fixed income and equities, they beat on. Deutsche did a good job on fixed income. But some of the banks are guiding to, well, costs may creep up because we have to make up for last year's lower variable comp. So costs are definitely going to be a debating point into the second half. Revenue growth, something we talked about for months and months and months, is back to the fore because there isn't very much of it, particularly net interest income growth. So I think those are two very key issues where we're beginning to see particular differentiation. And then you've got capital management as a way to drive earnings and shareholder returns. And that's where you look at a BBVA is going to buy back 10% of its shares. You've got UniCredit with a big buyback, NatWest, another big buyback announced. So we're definitely seeing from a capital management, sort of the lead management can pull, big differentiation between banks focusing on costs, capital management, and those that are sort of sitting there hoping the environment bails them out.
Right. All right, Jonathan, thanks so much. That's our Jonathan Tice, Bloomberg Intelligence Senior Banks Analyst. Coming up, big oil boost returns. We'll discuss BP earnings next. This is Bloomberg. Not playing games, Tencent slips the most in a decade after Chinese state media decries video games as spiritual opium. Bringing back the buybacks, Standard Chartered announces it will repurchase $250 million of shares and pay out a dividend as profits jump. And big oil's big beat. BP joins its peers in increasing buybacks and dividends as higher crude prices boost the bottom line. We'll hear from Bernard Looney. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. We're just heading up to 9:30 a.m. Now, looking at your market so far this morning, we are seeing a boost in both the benchmark index in Europe, the Stock 600, and American futures, both up between 2 and 0.3%, despite a wobbly session in Asia. Certainly got nerves going after fears of more regulatory crackdowns, but it's all about earnings season as we continue to look at the beats. We're looking at a U.S. 10-year yield higher by about a basis point after yesterday. Your nominal 10-year yields hitting the lowest since February, an all-time new low on your real yield. A real move into bonds, and the Aussie dollar moving higher today. There were some thoughts that perhaps the RBA would be more dovish in their decision. Instead, they're going ahead with the tapering. What does that portend for other central banks? But let's get to a key earnings story today. And BP is following its big oil peers in increasing dividends and share buybacks. That's, of course, as higher crude prices have boosted profits. BP CEO Bernard Looney spoke to Bloomberg's Anna Edwards just a little bit earlier.
I think our team has done a great job in the past quarter, and we have taken the decisions that you've just talked about, and they're really based on three things. Number one, Anna, it's the underlying performance of the business, which, if I can say, has been strong in the quarter. We delivered our cash cost savings target 6 months ahead of plan. We actually had the strongest convenience result in this quarter in our history. So the underlying business, first and foremost, is performing very well. Secondly, Anna, the balance sheet continues to strengthen. This is the fifth quarter in a row where net debt has come down now to $32.7 billion. And thirdly, it's about our confidence in the outlook for the environment. So when you look at it from that dimensions, they're the reasons that we've taken the decision that we've taken. $1.4 billion worth of buybacks in the third quarter and a 4% rise to the dividend. And actually, as we look out, Anna, over the next 5 years, at an oil price of around $60, we have the capacity to raise that dividend annually by about 4%, as well as, by the way, $1 billion a quarter approximately of buybacks. And that's about $4 billion a year at $60, which is probably 5% of the market cap of the company today. So that's really what this is about.
Okay, and you've increased the dividend and you're doing this share buyback. I think you've said in the past that any excess cash would go in share buybacks and not in an increase in the dividend. So is this a change of position on the dividend? Why that change in thinking?
So our financial framework, Anna, remains exactly the same. There are 5 elements to it, and the first priority in our financial framework is a resilient dividend, and that absolutely remains the case today. And priority number 5 is that we'll distribute excess cash, 60% of excess cash, to our shareholders in terms of buyback. What you're seeing around the dividend is really a story of confidence. It is a story of confidence in the underlying performance of the business. It's the confidence in the balance sheet. And 12 months on from when we laid out our strategy, of course, the world's in a very different place with the environment. Global GDP is now back to pre-pandemic levels. The vaccines clearly are working. People are back flying, not to the same extent, but they're back flying. People are back driving. Not alone that, but we're also seeing OPEC Plus has maintained strong discipline. And then, Anna, in the US shale business, which has typically been a huge responder to prices, you're seeing a different business model emerge there, where cost of capital is higher and investors and operators are being much more disciplined and focusing on cash. So it is a very different world, and that's why we've gone ahead and made the decision that we've made around the dividend.
BP CEO Bernard Looney speaking to Bloomberg earlier this morning. Let's dig in to earnings and how the markets are shaping up amid all of these reports. Joining us now is Bloomberg MLive editor Eddie van der Walt. Eddie, okay, so another really busy day for earnings. We just heard from the BP CEO there saying, okay, we're giving out dividends because we're just so confident in our results. Should the market be confident in big oil's results as well?
You know, I think that's the story across the board from these earnings. The question is whether these companies will be able to sustain it. I think the problem for a company like BP is that its problems hasn't gone away. A lot of the upside that they've seen here is a result of OPEC and of the cuts in production. Now, yes, oil demand is bouncing back, but at the same time, there's a lot of people are finding that they love electric vehicles. A lot of governments are saying, look, ESG and we see the pandemic as an opportunity to pivot towards green economies. And I think that hasn't gone away for these companies. We asked Markets Live readers at the beginning of the year where they see oil prices at the end of the year. They were talking about $45. Now we're sitting at $70. I think a lot of that has to do with OPEC. And OPEC is starting to show signs of cracking. OPEC is starting to show signs of wanting to pump more oil. Right. So whether these prices are going to be sustainable, we shall see.
And is that kind of the story for just the commodity space in general? Obviously, OPEC is a very, idiosyncratic driver. But just in terms of, okay, do we have this commodity super cycle? Is that just over now? Is that no longer in the picture?
So the commodity super cycle is a really interesting one. And I think, you're right. The BCom is down over the last 3 days. And we're definitely seeing some softness there. And the reason we're seeing some softness there is because China is suffering a little bit, right? Chinese consumers are not as strong as we assumed that they would be. And in the West, we are pivoting away from goods to services. I had my first holiday, in about 2 years, just last week. And, a lot of people are doing that. They're not spending money on iPhones and on goods anymore. They are spending money on going out.
Yeah, Eddie, you need more holidays. That's
we all do, don't we? But I think China therefore suffers a little bit, and that is weakness for commodities in general. So I think we are seeing commodities come back a little bit, which takes pressure off inflation.
But it used to be that the Chinese economy and the picture in China would tell us something about the global economy, that the way they go is going to affect all of us. Is that still the case right now?
I think you've absolutely nailed it on the head. That's the big topic for me. I think that we might see a little bit of a decoupling here. And I think the central bankers in the West will love it, because I think if we spend more on services, that means more employment in the West. At the same time, less inflation, because we're not putting so much pressure on the supply chains, right? And if we don't see that much pressure on inflation, they can keep rates lower for longer, and equity markets can keep on rallying.
I see. Well, it certainly is going to make a lot of difference coming up as we continue to see pressure emanating from China. Eddie, thank you so much for joining us today. Always a pleasure to have you on. That's our Bloomberg MLive editor, Eddie van der Walt, who hopefully we'll be going on a holiday again soon and won't wait as long this time. Now, coming up, we're going to continue the earnings conversation. Generali is set to start the process of board renewal in 2022. We'll talk to the CEO, Philippe Donnet, about his outlook for the Italian insurer. This is Bloomberg.
the Delta variant is on the rise. Infections are increasing, but at the same time, vaccinations are also increasing. So I remain very prudent when it comes to predicting economic activity going forward, because we have to see how the Delta variant is impacting us, while at the same time, vaccination is increasing.
That was AXA CEO Thomas Buberl speaking to both me and Manus Cranny earlier this week. Now, the French insurer saw a rebound from the COVID hit, with its profit more than doubling. First half earnings results across the insurance industry do show signs that the sector is recovering from the pandemic. Italy's biggest insurer, Generali, reported first half net income of 1.5 billion euros, up from 774 million euros a year earlier. Generali confirmed performance is on track to deliver this year's targets, as COVID-related impairments on investments were not repeated. Let's get more into this. We're joined now by the CEO of Generali, Philippe Donnet. Philippe, first off, thanks so much for joining us today. Really strong set of numbers out. First half net income beating analyst expectation. Outlook is strong as well. So going forward, where are you seeing the biggest opportunities for growth?
I think there are great opportunities because of COVID. Many people during this terrible crisis have understood that they are not protected enough. I'm talking about families, I'm talking about small businesses, small companies, SMEs. And this is a great opportunity for us. As you know, we are very much focused on families, on SMEs, and we are providing more and more personalized solutions to protect better our customers. And in Europe, and as you know, we are the leading insurance group in Europe. Europe is full of growth of opportunities for better protecting people against risks of life, against health problems. So many opportunities for Generali in the future.
Right. Well, when it comes to those opportunities, let's talk about M&A, because, of course, that features in this earnings presentation as an important key to reaching your 2021 plan. What type of deals are you targeting? What specifically are you looking at?
We are looking at opportunities that allow us to accelerate the implementation of our strategy, which basically is to further diversify our portfolio of business. So we are focused on P&C business, on protection business, on unit-linked business, on asset management business. On a geographical standpoint, we are willing to further strengthen our market position, especially in European countries. Basically, we want to continue doing what we have done in the past few years when we acquired some company in Greece to become the number 2 player on the P&C business in Greece, when we acquired a company in Portugal to become the second player in Portugal. This is exact. And when we acquired a company in Malaysia to become the second player on the P&C and health business in Malaysia. So we like this medium acquisition with low execution risk, which allow us to extract synergy and create value for our shareholders.
Okay, so more medium type acquisitions. I want to stick in Europe and talk about something that's featured heavily for a lot of insurers, and that's been some of the natural disaster and the claims from that. And the earnings, you cited 218 million euros coming from the storms, be it in Spain in January or June, some of the storms in Europe. But of course, in July, we've also seen some impact to Germany. What level of claims are you expecting to come forth from that?
Well, definitely what happened in Germany is very important. It's also very sad because, as you know, many people lost their life. Families have been impacted. We are a very important player in Germany. We are the second player in Germany. So definitely there will be an impact. But as you know, we are very well protected with our reinsurance treaties, and our net impact could not exceed 100 million on this event as well.
Okay, and in terms of just the spread of the variant and Delta, how does that impact your outlook?
It's difficult to predict what's going to happen. We strongly believe in the vaccination. By the way, in Milan, we have created the biggest vaccination hub in the region. It's really important. This is, according to us, the only way to fight any kind of variant. The vaccination is progressing quite well in Europe, so we feel quite confident that we will be able to manage the next wave, because the next wave is coming, and that will be able to protect the economic recovery. So we are quite confident.
Right, and that's definitely something everyone is looking for, some protection and concerns about another wave. Philippe, your term as CEO expires next year. Will you be running for a new term?
Well, the whole board of directors expires next year. And as you know, we decided during the board of directors yesterday to start the preparatory work to prepare the procedure that will be submitted to the next board of directors. So the procedure to make the new list for the next board of directors. So this is my personal situation is part of this, and it's a bit early to talk about that.
All right, a very diplomatic answer, Philippe. Definitely appreciate it. That's Philippe Donnet, CEO of Generali. Thanks again for joining us this morning. Now let's get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Societe Generale has given an upbeat outlook for the year as it set aside less money for soured loans and reports a rebound in equities trading. Paris-based SocGen predicts business will increase in all units after revenue and net income for the bank as a whole blew past estimates in the second quarter. Now, BMW has joined other car makers in reporting strong earnings dampened by warnings about the global chip shortage. Earnings before interest and tax surged to 5 billion euros in the second quarter, while ahead of estimates for 4 billion euros. Meanwhile, Stellantis, formed from the merger of Fiat Chrysler and PSA Group, raised its full-year profitability forecast, and that was substantially. Strong demand and pricing saw the company beat estimates in its first earnings report. And that's your Bloomberg Business Flash. Danny.
Leanne, thanks so much. Now, up next, we're going to talk about life after Libor. A Fed-backed body endorses a new benchmark, a milestone in the transition away from Libor in the U.S. We'll get into all the wonky wonderfulness for you. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, the transition away from Libor has reached a key milestone in the U.S. Officials at the Federal Reserve-backed Alternative Reference Rate Committee, or ARRC, have officially endorsed a series of forward-looking benchmarks that are tied to SOFR. Now, specifically, they have backed the CME's term rates for 1, 3, and 6-month tenors. It comes following the key completion of a key change in dealer trading conventions as part of the SOFR First initiative. The announcement is expected to pave the way for SOFR's usage more broadly in markets. Joining us now to discuss is our money markets reporter, Alex Harris. And Alex, this, of course, is hugely important. Hundreds of trillions of dollars in financial products and loans tied to Libor and need to look for a change, a different way to operate. So the ARRC endorsing this forward-looking term rate structure for SOFR, why exactly is this such a big deal in terms of getting a replacement for Libor?
Thanks, Danny. So the big issue with this has been, the cash market. The cash market has not wanted to transition. They said we're holding out for this forward-looking term rate because they were looking for something that was simple to replace LIBOR, and it just wasn't there yet. The way the transition was kind of done, if you look at sort of how markets have developed, you've always kind of had the cash market come first, and then you've seen the derivatives. This was sort of done in a backwards way, where the derivatives market for SOFR was created first, and you needed to see that pick up in order to get that term rate based on the way that they were structuring these things. But the cash market was saying, these conventions aren't working for us. We need just a forward-looking term rate, something that looks like LIBOR but isn't LIBOR, that's tied to the secured overnight financing rate, which is essentially underlied by a trillion-dollar repo market.
Alex, there's still been a lot of holdouts in terms of actually using SOFR. So you have, for example, users of syndicated corporate loans, collateralized loan obligations, really holding out. Does the introduction of these terms, does that help to address the issues that are holding them back from adopting SOFR?
I think that's I think that's the idea. Is again, like I had said, they wanted something that looks like LIBOR but isn't necessarily LIBOR, and so that's what I think they're hoping to get out of this. The other side of this, though, is the banks, and this is where that credit sensitive component comes in, is that they're still taking on a lot of that credit risk. And so they're considering, whether or not this is suitable for them as well. So it's going to be sort of a two-way street in figuring out what's best here. But I do think that there is that opportunity for pickup.
So, Alex, if we're trying to kind of figure out, okay, is this endorsement working? Are more people adopting SOFR? For a more casual observer for this, what are sort of the expert data points that you look at to assess how the adoption is going? What should we be watching out for here?
Well, I think, first of all, you are going to be looking for issuance. Are we starting to hear about more companies issuing loans, CLOs, those kinds of cash products tied to term SOFR? So that's first and foremost. I think secondly, from like a more nuanced market perspective, we're looking at bid-ask spreads in SOFR swaps, because that's what SOFR First Initiative ultimately did in forcing the dealers to move to these trading conventions. It's supposed to narrow those spreads. And so if it makes it cheaper to transact in SOFR for your clients, they might be more inclined to do SOFR swaps and other kinds of hedges in SOFR as opposed to LIBOR, because it is just going to be a bit cheaper for them now.
Alex, thanks so much for joining us. Of course, this is a very complicated topic. Really important to have you walking us through it, and of course, waking up early to do it as well. Thanks again to our money markets reporter, Alex Harris. And just to let everyone know, the Bloomberg Short-Term Bank Yield Index, also known as BSBY, an alternative to dollar LIBOR, is administered by a subsidiary of Bloomberg LP, the parent company for Bloomberg News. Now, a quick check on your markets as we close out the hour. We're looking at markets higher, both in terms of U.S. futures and your cash trading in Europe. We're looking at not much movement on your 10-year yield at 118. We'll continue to discuss these market moves in the next hour. Bloomberg Surveillance Early Edition continues on. Matt Miller and Kailey Leinz will be joining me both out of New York. This is Bloomberg.
If you're not Apple, and you should be way down the road in terms of contingency planning, just so you don't have over-reliance on China.
Investing heavily in China and the rest of the region. We're very confident about the long-term macro growth trends in Hong Kong, mainland China, and the rest of Asia.
Geopolitical tensions are always on our mind, but the fact is the Chinese economy is going gangbusters. The Chinese connection to the rest of the world is increasing, not decreasing.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, August 3rd. Our top stories today: Tencent tumbles, China media blast raises concerns that Beijing's next crackdown will be aimed at online entertainment. SocGen's sunny outlook, the French bank gives an upbeat forecast for the year after beating estimates. And why the virus may affect the vote. A Republican senator tests positive for coronavirus, possibly throwing a roadblock in the way of the infrastructure package. I'm Danny Berger in London alongside Matt Miller and Kailey Leinz in New York. Francine Lacqua is off this week. And look, equity markets might be moving higher in Europe and the U.S. today, but Kailey, the handoff from Asia seems to be less about animal spirits and more about spiritual opium, it would seem.
Yeah, Danny, that's exactly right. The risk-off tone was definitely evident once again in the Asian session. Concerns around a regulatory crackdown from Beijing once again rearing its head. We did see the CSI 300 manage to close essentially flat on the day, but the Hang Seng was lower by a few tenths of a percent, and the Hang Seng Tech Index actually fell 1.5%. And the big drag within that was Tencent. This after China's official news agency was out with an article that has actually since been deleted, at least online, calling gaming the spiritual opium and really criticizing it. And of course, that raises concerns that online entertainment could be the next target of Beijing in terms of this clampdown. And Tencent now says it may not even sell games to people under 12 anymore. That took the stock down 6%. That was off session lows, though, by the close. And in foreign exchange, my focus is elsewhere in the Asia Pacific. Your big outperformers include the Kiwi and the Aussie dollar. The Kiwi stronger against the U.S. dollar by about 0.5% on bets of policy tightening, and the Aussie dollar stronger by about 0.4% as the RBA says it's sticking to its taper plan even despite the current virus outbreak in Australia. As for the picture here in the U.S., of course, we did see that softer ISM manufacturing print yesterday that saw stocks close around session lows and yields moving dramatically lower. This morning, though, we are up about 0.3% on S&P 500 futures, and we are ticking just slightly higher on the 10-year Treasury yield right now at 1.18%, just off of the lowest level since February. The dollar is weaker for a 6th day in 7, and that may be part of what is helping oil recover. WTI fell 3.6% yesterday. This morning, though, futures up about 1%. Trading at $71.91 a barrel, Matt.
I'm not sure spiritual opium is really that bad. I think some people maybe need a little bit of spiritual opium in their lives once in a while, but just not too much. That's the problem. You don't want to get addicted, and with video games, I guess that's kind of what they're pointing out. Take a look at what's going on in European markets. Actually, we had much bigger gains at the beginning of the session. So in the last hour, we've seen these numbers come down a little bit. You can see now we're little changed in Germany. Now we're little changed in Spain. We had much bigger gains there. We still have a strong session in France with the CAC 40 up 0.8%. Louis Vuitton Moet Hennessy doing extremely well there. In fact, take a look at a lot of the stock stories. We have so many corporate earnings out in Europe that I just picked a whole bunch of stocks here to focus in on. Oil is helping BP, but also earnings positive at BP, and they're going to be giving more money back to shareholders. This is the story with the oil producers, up 3.5% right now. It's a huge weight on the FTSE. It's a huge weight on the Stock 600 as well, so helping to lift those indexes. SocGen also is a story that we're going to talk about, doing better, forecasting a better future for the equities business, and also reducing those loan loss reserves, helping SocGen, as it has with other banks, European banks that have reported. And then a couple of car makers. Stellantis is, of course, Fiat Chrysler after its merger with PSA. I'm still not 100% sure why they're called Stellantis. In any case, they're doing very well today as they forecast margins of 10%. EBIT margins of 10%. That's like the holy grail for automakers. That's like what Ford does with the F-150. You want that kind of margin as your goal, and they're hitting it. BMW has forecast margins of 7 to 9%. Not bad for a German car maker, not bad for a European car maker. The problem here is they're saying the chip problems may last longer, and that's really overshadowed the big earnings beat. I will point out they had earnings of 5 billion euros in the quarter, and analysts were only looking for 4 billion, so 25% better than the street's estimate, and nonetheless, the chip problem is taking them down 4% on the DAX this morning, Danny.
Yeah, Matt, Morgan Stanley out with a note about BMW asking the question, what is sustainable? I mean, you just look at the share price you have there compared to Stellantis. There seems to be some disbelief that they can hit margins like you described with what Stellantis is pulling through.
Yeah, absolutely. And BMW hasn't pulled out all the stops in terms of shifting to an electric car maker. That seems to be a lot of what the market wants to see. We've heard, tens of billions in spending plans from Volkswagen, tens of billions in spending plans from Daimler. Stellantis is, I think, spending $30 or $39 billion on, turning itself into an electric car maker. Whether or not that's 100% what's really happening, it seems to be a story that investors want to buy into.
Yeah, and BMW even citing higher motorcycle sales. I can't believe Matt Miller purchasing motorcycles didn't carry BMW.
I bought one this year. I bought one this
Very
year.
Strange. All right, well, let's get a look at what's ahead for today. At 10 a.m. New York time, we're going to get U.S. durable goods and factory orders. We also have SEC Chairman Gary Gensler giving a speech on crypto regulation today at the virtual Aspen Security Forum. Check out today's big read by Bloomberg covering all of this and Gary Gensler's views on crypto. And finally, we'll also be getting earnings results from Alibaba and Lyft. Let's turn to China, though, where China has taken another shot at another industry. This time, it's online gaming. Tencent plunging after an offshoot of China's official news agency criticized video games. Let's get more on this with Bloomberg's Zeping Huang from Hong Kong. So, Zeping, the state media putting this out, but then shortly after removing the link online for this article that called gaming spiritual opium. What do we make of those moves?
Right, so the article we saw in the morning is from a newspaper owned by Xinhua, which is China's top news agency. But it's worth noting that it's not an official Xinhua editorial, but it's an investigative piece done by state reporters. That the story was removed later around noon today is probably a sign the reporters went too far, triggering a market sell-off they didn't expect. But the report itself still carries weight as we see from what investors reacted. Like in the past China tech crackdown, investors first sold their stocks before they asked questions. And also later in the afternoon, we saw Tencent came up with a pledge where it says it will further cut time play for its minor users.
Of course, another Chinese tech company that has been a victim of the regulatory crackdown is Alibaba, and we will be getting those earnings later on this morning here in the U.S. What kind of bellwether could it be?
Right, I guess in Alibaba's case, it already paid a record 2.8 billion antitrust fine, so it's trying to move on. So investors will focus on its core China commerce business, but it's worth noting that the second quarter is relatively uneventful because overall China's online sales isn't doing that great. And then it's also worth paying special attention to Alibaba's cloud computing revenue. Last quarter, we saw the segment grew the slowest since 2014 after a key client, which source told us is ByteDance, withdrew their contract with Alibaba. So how will the cloud do this quarter, in the past quarter, will be a key area to pay attention to.
We'll watch closely, Zeping. Thanks very much for the insight. Bloomberg, Zeping, Wang there talking to us about the spiritual opium, Tencent and Alibaba that's to come. Now, European bank earnings continue. Stanchart overcame economic headwinds across Asia, and Soc Gen gave an upbeat outlook. We spoke to top executives from both banks on Bloomberg.
We had a stellar first quarter. Things actually slowed down quite a bit in April, picked up in May, picked up some more in June. And I would say the level of business activity continues to remain pretty robust.
We have announced a share buyback in the second half of the year. So we will complete the share buyback. That's obviously pending a necessary administrative authorization by the ECB for an amount of 470 million euros. And in the years to come, the payout on which we provision for our distribution, i.e. 50% of underlying results, includes a portion of share buybacks.
Bloomberg finance reporter Tom Metcalf joins us now to talk about really this trend, Tom. We've seen people just reducing loan loss reserves, and that's helping, but also give an upbeat outlook, some of these banks, Soc Gen, for example, in terms of equities.
Yeah, absolutely. It's kind of the message coming from all the European banks this earnings season. You're like, hey, we're blowing past estimates, but as you point out, that's in part because of loan loss releases. But also saying, hey, this is not as bad as we feared, and things are looking up for this year and next.
And what about buybacks and dividends? Should we expect to continue to see these kind of increases, Tom?
Yeah, so Winters on Bloomberg TV earlier did sort of suggest that maybe, even this year there might be another buyback. So they're just constantly looking at their capital levels and seeing how they can best use it. So he indicated, hey, we might do some M&A, but equally, if we can't find a good M&A opportunity, expect buyback.
Tom, thanks so much. That's Bloomberg's Tom Metcalf. Now from banks to D.C., where Lindsey Graham, a key Senate Republican, has tested positive for coronavirus, and that could delay Democratic plans to pass that infrastructure bill this week. Bloomberg Washington correspondent Anne-Marie Horton joins us from our D.C. bureau. So the timeline is upset, Anne-Marie, but does this change the likelihood that we actually get this infrastructure bill passed?
Well, whether or not we do have a vote from Senator Lindsey Graham, depending on whether or not he will be in quarantine, is unseen at the moment. And the legislation could pass without his vote. But he was a critical member of that bipartisan 10 group of senators to come up with this. And he was also key to getting other Republicans on board to vote for it. And he's a key voice for this legislation. And unlike the House, the Senate does not have proxy voting. So his vote would not be there if he was still in quarantine. So that's one thing we should keep an eye on. The second is that he was in attendance of a gathering over the weekend with a number of other senators on Senator Joe Manchin's House vote from West Virginia. Now, all those senators who said they were in attendance are following CDC guidelines and have tested negative. But, Danny, it just brings this cloud of worry over Congress about potentially more positive cases and these breakthrough cases when it comes to coronavirus. So this could potentially be a wild card when you have Senator Chuck Schumer saying he wants it done by the end of the week.
Anne-Marie, there also is still a focus on the eviction ban. The Biden administration asking the CDC to extend the moratorium in a targeted way. Will that happen?
It's very difficult to see how this can happen, given what we heard from the Supreme Court at the end of June. The Supreme Court saying that it has to come from Congress. And even in that memo following that decision, Justice Brett Kavanaugh said that this would give states and local authorities enough weeks to potentially tap some of that $47 billion of rental assistance. And just a fraction of that has been used, about $3 billion. So legally it'll be difficult for the White House, and they are on the phones trying to get this through. They're come under a ton of pressure from their own party, the progressive left. You even have some representatives sleeping on the steps of the Capitol to draw attention to the fact that millions could be evicted from their homes. That is one thing they're trying to do legally, but it does seem that's going to be a lot of hurdles. So they are really pushing for state and local authorities to tap that money that is there waiting to be used.
Although at the last minute, right? They could have started a little bit earlier.
Well, here's the thing, Matt, and it's a very good point. A lot of members of Congress were saying how do you tell us on Thursday that this is going to end on Saturday and give us 2 days to try to whip up votes to get this through? The problem is, though, at the end of the day, we all knew this was coming. The Supreme Court decision came at the end of June, and it was made very clear that it would have to go through Congress.
All right, Anne-Marie Horton, Bloomberg Washington correspondent, thank you so much. I do want to take a quick check now on some stocks moving in pre-market trading here in the U.S. And a big one to the upside is T-Bio, which of course is up 29%. Sanofi buying the company for $3.2 billion, trying to push more into messenger RNA, paying a 30% premium to yesterday's closing price for it. Another stock moving to the upside is Zoom Info, a marketing software company. It was out with a beat and raise quarter after the bell last night, up 13% in early hours as a result. And finally, one more stock moving to the upside is DigitalOcean. Citron Research was out with a report yesterday saying the company is like the Shopify of cloud computing, slapping a $200 price target on that stock. This morning, it is trading at just $59.80, though it is higher by about 5.5% before the bell, Danny.
Wow, that's quite the upside price target. Will anyone be able to challenge AWS? Always interesting to see research that suggests so. We'll get into the more market conversation more coming up next. We have Julian Chillingworth, Rathbones Chief Investment Officer. Later, we're going to be speaking to Grace Peters, JPMorgan Private Bank EMEA Head of Investment Strategy. More conversations to come. This is Bloomberg.
I don't think that the market is concerned about Delta as much as they're concerned about what Delta will do in terms of how it impacts inflation. And I know that seems odd, but the more we have Delta spread globally, the longer the supply chain disruptions will continue.
And that was Shanna Cecil, CIO at Spotlight Asset Group, speaking earlier on Bloomberg. Joining us now is Julian Chillingworth, Chief Investment Officer at Rathbones. Julian, we were talking to Shanna about low rates. Why are we still seeing less than 120 on, you know, the 10-year or negative 120 on in real rates. And no one's really come up with a great answer to the question, but it definitely points to something that's amiss. How do you see it?
Well, I think the way we see it is that the message coming out of the Fed is pretty clear that they are not really moving to tighten monetary policy or rates in the near term. It's the message from Jay Powell, despite some of the comments from his fellow Fed governors. And that's because the labour market is not back to a level that they had been viewed as being satisfactory for them. And I think we've got the upcoming non-farm payroll numbers coming in Friday. And I think they're going to be looking closely at those.
So with yields where they are, how does that make you want to rethink your equity strategy, Julian?
Well, I mean, we continue to favour equities and we'll continue to do so in the current environment. And we believe that we're going to continue to see decent pickup in company profits, inventory rebuild, and particularly probably a switch from consumers moving more towards services from goods. And that will be good for certain areas, hospitality, etc. And I will point out that if inflation does remain higher than expected, then certain areas of the equity market will remain more resilient, like financials and energy names.
I mean, it is remarkable, Julian, in these earnings, we keep hearing about companies warning about higher prices, and some of them warning about, okay, we're going to see this out into 2022. As the market starts to shift from concentrating on this earnings season to next year, what do your inputs look like right now when it comes to the cost pressure that corporations are going to face?
Yeah, I mean, I think that they are going to face some cost pressures. I think the labour issue will begin to unwind. The real pressure for labour is more in the US than it is in Europe. And I think that as the COVID-19 payments unwind, and they're already doing that at state level, you will see more people returning to the workplace, and that will ease some of the labour pressure. And I think that some of the supply chain bottlenecks are going to begin to slowly unwind, with particularly around transportation and to the back end of the year around electronic components, particularly chips. So I think there will be pressures, but I think they will be manageable. Yeah. And I therefore think we're continuing to see decent earnings numbers come through.
My question is, does demand fade from here, Julian? I mean, have we all kind of gotten it out of our system in terms of what we need to be spending our pent-up savings on? Is that ship sailed now?
Yeah, well, I think goods is probably basing out, but services is where I think you'll see a big pickup. So more people eating out. And it's very interesting. I saw some data out of a Florida activity survey recently where a pickup in restaurant bookings is continuing despite a rise in the Delta variant, and also footfall in shopping malls remaining high. So I think people will get out there and they will be looking to get more into the buying services than necessarily buying more things.
All right, we have to leave it there, but thank you so much for your insight today. That's Julian Chillingworth, Chief Investment Officer at Rathbones. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Francine Lacqua is off this week. Now let's get the first word news. And the surge in COVID cases is increasing pressure on U.S. drug regulators to fully approve the Pfizer vaccine. It's the only one that was the first to apply for full licensure in the country. Approval could help the Biden administration ramp back up its immunization drive and reassure vaccine holdouts that the shots are safe. It's the biggest resource injection in the history of the International Monetary Fund. Member nations have approved $650 billion to help countries deal with mounting debt and the fallout from the coronavirus pandemic. IMF Managing Director Kristalina Georgieva calls it a shot in the arm that will help boost economic stability. And a labor union may get the chance to reverse its loss to Amazon. Bloomberg's learned that a federal official has recommended overturning the results of a union election at an Amazon warehouse in Alabama. The National Labor Relations Board hearing officer says the election should be run again. Amazon can appeal that decision. The union accused the company of making anti-union threats. And coming up next, we'll get back to the markets and European earnings season with Grace Peters, JPMorgan Private Bank EMEA Head of Investment Strategy. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, alongside Matt Miller and Kailey Leinz, both in New York. Francine Lacqua is off this week. Now, Matt, here in the UK, we are dealing with something very specific related to COVID called the ping-demic. That is, you get a ping on your phone when you have an alert that you've been close to someone who is tested positive for COVID. The government yesterday announcing they would reduce the sensitivity. I mean, I think there's a saying about a horse and a gate. It might be a little bit too late. There are already so many people in isolation because they've got a ping on their phone.
Yeah, I mean, there are, but maybe there won't be in the future. And I think the point is, you know, if you're vaccinated, you're less likely to get it. It's starting to seem like it's still very, very possible that you do, but you're very unlikely still to get seriously ill. And I've looked through the CDC numbers. I've talked to a number of epidemiologists and doctors about this over the last few days, and maybe it just doesn't matter as much. I mean, a lot of people, doctors have been telling us, if you're vaccinated, don't even bother getting tested because you're just going to be fine. Now, the problem is then you're going to be spreading it to a lot of other people, possibly those who are unvaccinated, and that's where the real problems come in.
I mean, I think this is an interesting thing, Matt, because you might say, okay, you're vaccinated. It doesn't matter if you get it. You won't be hospitalized. But Kailey, it feels the market still cares. The market is still concerned about growth concerns when it comes to the spread of the Delta variant.
The question is, Danny, does it change consumer behavior? Because even if the science says that if you're vaccinated, you won't get that sick, people still may be less willing to go out into this economy and spend, to go back to the office, to do those things. So that is really where the growth concerns come from. They don't seem that evident, though, at least this morning, because you are seeing stocks higher in the European session. The stock 600 up by about 0.25%. And here in the U.S., futures are pointing to a firmer open in about 4 hours' time. We're up about 0.3 on S&P E-minis. Of course, we did see yields moving pretty dramatically lower, down 4 or 5 basis points yesterday off of softer ISM manufacturing data. But of course, we are lifting just a touch, 1 or 2 basis points on the 10-year Treasury yield, but still at 1.19%. We are south of 120 and right around the lowest levels since February. I would also point out that oil is rebounding after a 3.6% drop in WTI futures yesterday. We're up about 0.7% right now to 71.77 a barrel. Of course, it also still is earnings season, and we have a number of earnings movers, related earnings movers in pre-market trading. Of course, Stellantis, the automaker, raised its profitability outlook today. It really is benefiting from the fact that car prices are so high. That's helping out margins. It's up 5.4% in early hours. Zoom Info is higher by 14% after a beat and raise quarter, but the story is less good for Take-Two, the video game maker. Its revenue guidance missed expectations. That stock down 4% as a result. And of course, we will be getting earnings from Alibaba coming up at 7 a.m. Eastern Time, a really big bellwether for Chinese companies. That stock just slightly lower ahead of that, Matt, down about 0.9%.
You know, I'm also Stellantis, which owns Jeep and Ram. I think they make the biggest inches. I mean, the largest displacement V8s at 6.4 liters. Short of course, Rolls-Royce or Lamborghini or Bugatti. In terms of a regular truck that you can buy, that's the biggest displacement. And I've always thought there's no replacement for displacement. But I digress. I do want to talk about oil, and I've got a chart. I'll welcome our listeners on London DAB Digital Radio and just tell you what this chart shows. In white, we've got the oil price. And yes, it's been really volatile the last couple of days. But since the bottom of the pandemic, it has just gone up, 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 up to between 70 and $80, depending on whether you're looking at NYMEX or Brent. There's a blue line here that shows the stock 600 oil and gas producers. And, you know, the gap at the beginning of the year, people were saying, you got to play this gap because the oil and gas producers haven't done anything near as well as the actual underlying commodity has done. Well, that gap has just widened. Now oil is up something like 41% year to date, and the producers are only up 5%. I wonder why. Why aren't producers doing quite as well as the commodity that they pull out of the ground? Joining us is Grace Peters, EMEA, Head of Investment Strategy at JPMorgan Private Bank. Grace, is this all about ESG? Are investors just shunning the BPs and the Royal Dutch Shells of the world because, you know, they're not doing nice things for climate change?
Morning, Matt. Good to be on the show. So I think firstly, just to start with the oil price itself, we think we're now in the range of what is going to be a fair value for oil, $70, $75, when we look out over the next 12 months. As you say, when it then comes to oil equities, we have seen the complex lag quite considerably since the start of the year. And broadly, I think categorizing that as due to ESG concerns is right. But more specifically, why be concerned? We know that oil majors have got quite a heavy capex burden ahead of them as they transition their business models towards, alternative sources of energy. And I think investors are concerned about how managements balance that capex burden with achieving a rate of return on the spend, but also with requirements around still debt pay down, reducing leverage, and of course share buybacks and dividends. So I think what we've heard from corporate earnings season, this morning out of the sector and broadly so far, is reassuring when it comes to being able to achieve that balance.
Well, and we've seen beats really across Europe. I mean, BP was out with second quarter adjusted net that beat the street's estimates. I was just talking with Kailey about BMW, which clobbered estimates. It's still down, but I believe something like 62% of European companies have beaten estimates, and it's a lot harder to beat estimates in Europe than it is here in the U.S. historically. Are analysts becoming too optimistic, though, at this point about European earnings? I mean, we're at record levels. We have EPS estimates that are continually upgraded to catch up with these beats. Are we at the peak?
I would push back on that a little bit. I think that, when you look at Europe's earnings this year, we're penciling at around 45% EPS growth for the stock 600. 11 to 12% next year and high single digits the year after. So we think earnings can continue to climb in line with the macro backdrop where we see global growth remaining above trend out to 2023 and beyond. When it comes to investing in Europe, the key thing to remember is the other side of the equation, not just the earnings growth, but the valuation that you're putting on that earnings stream. And here we think the story is actually pretty interesting because when you look at European equities relative to US equivalents, both at the index level and below the index into specific companies, there is a huge and we would say unwarranted gap between Europe and the US. So at a headline level, that's a 22% discount. Historic average is around 15%. And if we go back to 2012, when we were coming out of the European sovereign debt crisis, we were back at 22%. So that to us feels like an opportunity for a bit of a catch up when it comes to European equities.
Europe, that's European equities. Talking about another region of the world, in China, we continue to see this regulatory clampdown rearing its head. Can you invest in China right now?
I think when it comes to headwinds for China, they are plentiful. Growth was already slowing, and now we have concerns around, infection rates rising again. You've obviously got the credit cycle, and throughout this year, but particularly coming to a head over the last week or so, regulatory concerns. So all of those present quite material headwinds when it comes to investing in China. But that said, again, let's go back to fundamentals of growth we think we can get out of the region, and what you're paying for that growth. And again, we do see opportunities pretty selectively, but we do think that there are opportunities in China. So we have been adding to portfolios on some of this weakness in the A-share market and in some of the internet names with a healthy dose of skepticism attached to that, of course.
So adding when there's weakness in China, Grace, in your research, you write more generally about if there is a potential correction that you should have a shopping list. What's on your shopping list if we see a wider correction in these equity markets?
Yeah, I think the context here is that we haven't had more than a 5% pullback in markets, talking US European equities, since October of last year. That's not unprecedented, but it is quite unusual. So in terms of that shopping list, where would we be looking? First and foremost, we'd be looking to add cyclicality that also has secular supports. We're not so much in the pro-cyclical trades that are just beta driven now. We want to see some of the secular supports, around fiscal policy, infrastructure spending play out. So that would be area number one. And the second area would be around growth at a reasonable price. So we're looking for mega trends, secular growth, where we've seen a real step change in prospects because of the pandemic. So digital transformation and the energy transition would be two pretty obvious areas. But we also see parts of the market exposed to, say, the circular economy, so waste, plastics, alternatives, sustainable fashion and industry. All of these parts of the market we think are incredibly interesting as well.
So that's your shopping list, kind of the buying on dip side of the equation. What about on the selling on rip side? Is there anywhere you'd be taking profit right now?
Yeah, totally. So we've got quite a healthy outlook when it comes to prospects for risk assets over the next 12 to 24 months. But that's not to say that we shouldn't be constantly reappraising and taking profits in parts of the market where valuations look a bit stretched despite those healthy fundamentals. So we've been doing that in parts of the high yield market. We've been doing it in US financials as well. And so they would be, where I would point to take some funds off the table and use that to rotate into parts of the market like Europe or some of those cyclicals and mega trends that I mentioned before.
Grace, always good to get some time with you. Thanks so much for joining us. Grace Peters is EMEA Head of Investment Strategy at JPMorgan Private Bank. Coming up, BMW's big warning. The car maker says chip shortage woes are not over yet. More next, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later on today, Eli Lilly co-chairman and CEO Dave Ricks. This is Bloomberg.
Global semiconductor shortage has been impacting us. And probably this quarter two will be very difficult for the old operation by knowing that the inventory level is quite low and how we can make sure to manage. So it is important to have the continuous monitoring the situation.
The chip shortage itself, on the back of a rebounding economy after the pandemic or the depths of the pandemic, it's been quite a whipsaw for us in the industry.
So how long does it last? I mean, are you going to get things back on track, say, by Q4?
Well, the chip information changes every single day, and it's a moving feast. But I do believe that our inventories as an industry will start to recover from later this summer, and so consumers will have more choice going into the fall and winter.
That was Mazda North America CEO Jeff Guyton and the CEO of Nissan speaking to Bloomberg as the global chip shortage continues to roil auto production. Joining us for more is Bloomberg Global Autos editor Craig Trudell. And Craig, we heard again from a big car maker, BMW, this morning saying that it's not over yet. And even though BMW beat the street's estimate for profit by 25%, the shares are selling off in Frankfurt.
Yeah, it's very interesting because BMW was one of the last ones to kind of buckle under this chip shortage. They were really sort of forceful in their language with, just how much they expected their suppliers to deliver. They felt like they, sort of saw this coming to some degree and made sure that they ordered enough chips to, keep production lines rolling. But they succumbed to this just like everybody else, and they do have an expectation that, rather than continuing to, largely stay above the fray, that this is going to get worse, which is something that, has, quickly become a consensus. I think there was an expectation that the second quarter would be, the sort of peak impact for the car companies. And that has changed more recently where they've, said, wait a minute, maybe third quarter might be, where we really see things hitting us hardest.
Craig, at the same time that they're dealing with kind of these supply chain issues, they also are able to raise prices as a result. And we saw Stellantis upgrading its profitability forecast because of that today. To what extent do the higher prices car makers can charge offset some of this pain from not being able to produce as many?
You know, it's been really remarkable. You actually kind of wonder how much these car makers ought to sort of learn a lesson from this ordeal that, you know what, maybe it would be best if we, you know, weren't able to make as many cars as we wanted to, because, you know, you look at the earnings power that they're managing. The inventory has been very constrained. They focused on their higher spec, higher end models. Stellantis, you know, does not have a particularly strong presence in the luxury market, but, you know, a lot of Jeeps, SUVs, and Ram pickups right now are selling for, you know, top dollar, and that's really flowing through to the bottom line for them.
I mean, this is interesting to me because BMW, we're looking at them build an electric car right now. And, you know, even the M cars have like 3-liter inline sixes. Stellantis builds these huge trucks, right? They have a Wrangler now with a 6.0-liter V8, or the Ram Power Wagon has that motor as well. They're not really very green, but they're selling for a massive premium. Isn't that a little bit ironic, Craig, that they're the ones doing so well?
Yeah, you know, and BMW, to be clear too, I think, you know, they're seeing this. I think we've seen Mercedes talk about this. We've seen Volkswagen talk about Audi and Porsche really having a great first half. So, you know, we're seeing this really kind of across the board, but with Jeeps, to your point in particular, I mean, we're seeing, you know, Wranglers going for, you know, starting at you know, $40,000, $50,000 depending on the sort of trim and version, and that would have been unheard of just a few years ago. This is a company that's really taken Jeep to, you know, significant heights in terms of sales. They're doing so, you know, while boosting prices to a significant degree as well.
So we also have GM earnings on deck for tomorrow, Craig. What are you expecting out of them?
They've managed this much better than Ford has. I think there was a concern that there was going to be a significant difference between the two, and I think Ford actually sort of, you know, to their own surprise, were able to get through the second quarter much better than they expected. They really kind of caught the market off guard, talking about, you know, we think production may be 50% of plan. That didn't materialize. But, you know, a very similar story with Stellantis, where you're going to see pickups and SUVs really driving North American earnings and being, you know, where their bread is buttered, and that's going to continue through the rest of the year.
Craig, always great to catch up with you, and always great to have someone on who speaks Matt Miller's language. That's Bloomberg's Craig Trudell. Thanks so much. Now, coming up, we turn to crypto and the explosion of venture capital. Part of our interview with Mark Andreessen Horowitz, co-founder from the latest episode of Bloomberg Wealth with David Rubenstein. Next, this is Bloomberg.
We view it as fundamentally a technological transformation. So there's a fundamental technological breakthrough that has actually happened, and it's an area of computer science called distributed consensus. So it's the ability for a lot of basically people and software on the internet to be able to form trust relationships in an untrusted environment. Money is one application of being able to have distributed consensus, but it's only one of those applications. There are many other applications, many other things that people are going to be able to do with this technology. And many of the smartest people in computer science are going into this field, and they're pushing it forward at a really rapid rate. So to us, it looks like it's just the 8th or 9th fundamental architecture change, breakthrough, technological transformation happening in the tech industry. And we take it very seriously because of that.
That was Andreessen Horowitz, co-founder and general partner Mark Andreessen. And to hear more of his insights, you can watch Bloomberg Wealth with David Rubenstein tonight at 9 p.m. in New York. Well, Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. That begins at 6 a.m. in New York. And Tom, it's about 74 and a half hours until Jobs Day, I think?
Yeah, it is. We're going to start on 3 days. We got quiet markets today, but Kailey, we're really getting set up for this incredibly important, some say 1 million job formation report on Friday, Wednesday claims, and then we go, claims on Thursday. Wednesday, we've got ADP, that first look, and then on to jobs. The chart's real simple. This is the only chart that matters. That's according to Lisa Abramowitz. This is labor participation. And then I've taken it down, Kailey, to the core audience, 25 to 54 in America, and we're just not back to where we were before the pandemic.
You know, I always look at Whisper Go, Tom, on the terminal to see what people are expecting for non-farm payrolls. But it's also interesting to see that clients expect the 10-year yield to still be at 1.20 by year end. And we're seeing real yields at like negative 120 right now. Are you getting any kind of consensus as to why yields are this low?
No, it's not so much why yields are low. I would say, Matt, what we're focused on is what are yields going to do, and there is no consensus. This was a major theme yesterday. Farrow demanded that we do this theme, the idea of just the absolute mystery of not only where yields are through August, but Matt, how do they get to the end of the year, and what will that statistic be?
So much still unknown. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now let's take a look at what else we're watching today. And Matt Miller, you are watching masks.
Yeah, San Francisco has now reinstated mask orders indoors regardless of your vaccination status. And this seems to be, coming back, possibly even for here in New York. I know you point out that Mayor de Blasio hasn't said that he's going to move in that direction, but it could be that the private market does it for him. You know, that companies start to see, oh, even our vaccinated employees continue to get sick. Now we're going to start reinstating mask orders indoors. I think a lot of, as you pointed out earlier, Kailey, Apple has already done it. Alphabet has already done it. They're demanding that people get vaccinations, but it seems like masks. I was on the Metro North yesterday, up to Bronxville to look for a house, and I had to wear a mask the whole time.
He just had to get that in there, Danny.
In case anyone knows of one.
Is Matt looking for somewhere?
Do you have a place for me, dear viewer?
Come on, guys, you got to send Matt some recommendations because we need him not needing to wear a mask at home with it off. I think that second order effects are interesting. Makeup sales for L'Oreal did really well. Maybe people will stop buying it if their faces are covered yet again. Anyway, I'm watching Gary Gensler from the SEC giving a talk on crypto at the Aspen Institute today, the Aspen Security Forum. He used to teach a class at MIT on blockchain and money. The Bloomberg Big Take today is on this. Recommend anyone read it. A good fun fact is that Goldman Sachs wealth advisors once boasted that they looked at 29 hours of his class and parsed through it. So this one will be parsed through too, Kailey.
29 hours. That is a lot of
29 hours.
All right, well, I'm watching Alibaba earnings. They should be crossing around 7 a.m. Eastern time. Obviously, a major Chinese company and a big bellwether for Chinese stocks in general. And of course, this will be particularly interesting given the accelerating regulatory crackdown from Beijing that is affecting so many Chinese companies, has affected Alibaba. Remember, in the first quarter, it reported its first loss in 9 years because of that anti-monopoly inquiry. So it'll be interesting to see how those results shake out in just about an hour or so's time. More Bloomberg Surveillance is still ahead. Stay with us. This is Bloomberg.